Hey, and welcome. We're jumping right into something seriously cool today. Building a business the old-fashioned way,
Uh,
with your own sweat equity and smarts, or bootstrapping, as they call it.
right.
Ever wonder how some companies just seem to pop up and grow without, a ton of fanfare or big investors?
Yeah, that's often the magic of bootstrapping, isn't it? Starting lean, reinvesting what you earn.
And calling all your own shots?
Exactly. It's about that independent spirit, that drive to create something amazing, on your own terms.
Totally.
And you know what? Some of the biggest names out there started exactly like this, fueled by sheer determination and just a knack for making every dollar count. It's a fascinating journey.
Absolutely. So our goal today is to really dig into what makes bootstrapping tick. We'll look at the core principles, why so many founders find it appealing.
And the challenges too, right? Got to be real about that.
Oh, for sure. The challenges and the triumphs. We've got some awesome examples and even a peek into how the numbers work.
Sounds good.
Okay, so if someone's thinking about going this route, what are the absolute, must-know foundations of bootstrapping?
Well, think of it like this. Bootstrapping has a few non-negotiables. First off is self-reliance.
Yeah.
You're the bank, at least in the beginning. Growth comes from your own pocket, or maybe the company's early earnings.
Right.
And it's all guided by a really, really careful financial plan.
Makes sense.
Then comes cost efficiency.
Yeah.
You operate lean, you avoid those big unnecessary expenses,
Uh-huh.
and you make sure every single cost delivers real value, like real value.
Right, got to be super resourceful when it's your own hard-earned money on the line. What else is key to this DIY approach?
A relentless focus on sales is absolutely vital. I mean, critical.
Sales first.
You need to generate revenue early and consistently. That's what keeps the lights on and fuels growth.
Got it.
And because you're not bringing in outside investors, the founders get to hold on to ownership and control.
The whole pie.
Exactly. They own the whole pie and make all the decisions. And finally, scarce resources. Well, they become this powerful motivator for innovation.
How so?
When you don't have endless funds, you learn to do more with less. You get creative. And that can lead to some really clever solutions.
So it's about being smart, resourceful, and staying firmly in the driver's seat. Okay. Now, one of the biggest things people talk about with bootstrapping is keeping that 100% ownership. Why is that so appealing to folks starting a business?
Well, what's truly compelling is the complete autonomy it offers. I mean, total freedom.
Yeah.
When you bootstrap, you own every single piece of your company. You don't have to share profits or decision-making power with anyone else.
No board meetings to report to?
Exactly. Imagine being able to make a major strategic move without needing to get a board of directors on board first. That freedom to set your own course, your own timeline, your own ambitions, it's huge.
That sounds incredibly freeing. Not having to constantly justify your decisions to investors must take a lot of pressure off, right?
Exactly. You avoid what's called dilution. That's when your percentage of ownership shrinks as you bring in more investors.
All right, your slice gets smaller.
Yep. Plus, you're not subject to the often intense performance expectations that come with outside funding. If you decide you need to shift your focus, maybe pivot, or try a new direction,
It's your call.
it's your call. That agility can be a real superpower, especially in the unpredictable early days of a business. For someone like you who appreciates different ways to grow, this self-directed approach offers a fascinating contrast to the more typical venture capital route.
It really highlights that business growth isn't just a one-size-fits-all model, is it? Now, having to rely on your own funds, that must really sharpen your focus when it comes to managing money, right?
Oh, absolutely. Bootstrapping breeds this deep sense of financial discipline. When it's your own capital or those early revenues fueling the business,
Mhm.
you become incredibly mindful of every single dollar that goes out. You have to prioritize ruthlessly, focus on generating positive cash flow,
Cash flow is king.
always. And you have to really make smart choices about where you invest your limited resources.
So every expense has to earn its keep, basically. And bringing in revenue becomes the absolute top priority.
Precisely. And since that revenue comes directly from your customers, well, it naturally leads to a strong emphasis on keeping them happy.
Right, because they're the ones paying the bill.
Exactly. You're not chasing investor metrics at the expense of your customer base. You're building a business that serves their needs. Plus, there's often a lot of respect earned by companies that are known for being self-made.
Yeah, that reputation.
It speaks to the resilience and viability of the business, growing sustainably without relying on outside help. People notice that.
That makes total sense. It builds trust and shows real commitment. Okay, now let's talk about a company that's often held up as a bootstrapping success story. GoPro.
Ah, yes, GoPro.
What can you tell us about their early journey? How did they get started?
GoPro's story is truly inspiring. Nick Woodman, the founder, started it all with just $30,000 of his personal savings
Wow, okay.
and another $35,000 from family. His vision was pretty simple: a rugged, high-quality camera for capturing action sports that wouldn't break the bank.
Right, for surfers and skiers and people like that.
Exactly. But instead of immediately seeking venture capital, he made a deliberate choice. He decided to plow any early profits right back into the company.
Reinvesting everything.
Yep, to improve the product, scale up production. This strategic reinvestment was absolutely key to their early growth.
So he was using his own success to fuel further expansion, not relying on outside funding at all in those early days. How did that translate into actual numbers, like revenue-wise?
Well, the growth was impressive. In their very first year, that was 2004, GoPro pulled in $150,000 in revenue.
Not bad for year one from scratch.
Not bad at all. Just a year later, that number more than doubled to $350,000.
Okay, gaining traction.
And by 2009, only 5 years after starting, their revenue had skyrocketed to $19 million.
Wow, $19 million in 5 years, bootstrapped.
Bootstrapped. They achieved profitability relatively quickly by keeping their overhead low and selling directly to consumers mostly.
Smart.
That early profitability created this virtuous cycle. It allowed Woodman to continuously reinvest those earnings back into the business.
Can you give us a clearer picture of just how much profit we're talking about? Like in those initial years, how much could actually be reinvested?
Sure, let's break it down simply. If we assume, say, a modest profit margin of maybe 15%, and this is just a rough estimate, of
Yeah.
course,
Okay.
in 2004, with $150,000 in revenue, that would be around $22,500 in profit.
Right.
Every bit of that could go right back into making more cameras or improving the design, marketing, whatever was needed.
Okay, so $22,500 back in.
Then in 2005, with $350,000 in revenue, same margin, you're looking at roughly $52,500 in profit available for reinvestment.
So more fuel for the fire each year.
Exactly. This consistent pattern of earning and reinvesting their own money was a huge driver of their organic growth. And Nick Woodman maintained complete ownership throughout this entire period.
That's amazing.
It really shows the power of a focused, self-funded approach.
That's a fantastic real-world example. It really clicks that aha moment of seeing how sustainable growth can actually be built from the ground up. So given this, in what kind of situations does bootstrapping typically make the most sense for a budding business?
Well, bootstrapping is often a really sweet spot for industries that don't demand massive upfront investments.
Like what kind of things?
Things like, huge factories or extensive physical infrastructure. If you're starting a business where the initial capital needs are relatively low, maybe a service business or certain software, it becomes a much more feasible option. It's also naturally a great fit for entrepreneurs who are fiercely protective of their ownership.
The control factor again.
Yeah, people who want to maintain complete control over their vision from day one.
So if you're not aiming for like hyper growth right out of the gate, or you don't have those enormous initial costs, it's a very viable path.
Exactly. And like we said, if a founder's core priority is to be their own boss and steer the company exactly as they see fit, well, bootstrapping aligns perfectly with those values.
Now, we've highlighted the advantages of staying independent. What are some of the potential downsides of taking on outside investors that might make a founder lean towards bootstrapping instead?
Well, when you bring in outside investors, the fundamental relationship you have with your business changes dramatically.
How so?
It's no longer solely yours. Investors acquire a piece of the pie. They get equity or shares. And with that ownership comes a say in how things are run. Suddenly, you might find yourself having to justify your decisions, your strategy, even the pace you want to grow at, to a board or individual investors.
So you're sharing control, which I guess can sometimes lead to conflicting visions or disagreements?
Precisely. And look, while many investors can bring valuable expertise and connections to the table, absolutely.
Right, it's not always bad.
No, not at all. But others might have different agendas or exert pressure that can feel misaligned with the founder's original vision. And there's also the very real possibility, in challenging times, of investors potentially taking over the company if certain performance milestones aren't met.
Oof. Yeah, that's a risk.
It's a significant shift in power dynamics. You have to be aware of that.
That paints a pretty clear picture of why maintaining that independence through bootstrapping can be so attractive. Now, switching gears a bit, I came across some fascinating data specifically about SaaS companies, software as a service.
Ah, yes.
SaaS, companies that have grown through bootstrapping. What are some of the key performance indicators, the metrics that stand out for these kinds of businesses that haven't taken on venture capital?
Yeah, that's a really interesting area. What's quite telling is how the metrics for bootstrap sauce companies often look quite different from their VC-backed counterparts.
Different how?
Generally, companies that take on venture funding tend to prioritize rapid growth, super fast growth, even if it means burning through a lot of cash and operating at a loss for a while.
Growth at all costs sometimes.
Kinda, yeah. Bootstrap SaaS businesses, on the other hand, typically exhibit more moderate growth, but also much lower spending. And crucially, they're often profitable much earlier on.
So slower, but maybe steadier.
Often, yes. It's a trade-off between that rapid expansion and building something sustainable and self-funded.
That makes perfect sense given the focus on self-reliance we talked about. What specific numbers should we be looking at when we talk about a successful bootstrapped SaaS company? Is there a benchmark?
Well, one particularly impressive group is bootstrap SaaS companies that have managed to reach between, say, $3 million and $20 million in what's called annualized run rate revenue, or ARR.
ARR. Okay, what's that again?
Think of ARR as the total recurring revenue a company expects to earn from its subscriptions over a year. Hitting that kind of level, $3 to $20 million ARR, without any outside investment is a major feat. It usually signals a really strong product that customers genuinely love, an efficient way of reaching those customers, a good go-to-market strategy, and again, that super disciplined approach to managing costs.
Okay, so what do the metrics look like for those companies?
For 2025, the benchmark showed the median revenue growth rate for these companies was around 20%,
20%. Okay.
which is solid, steady growth. The top performers, the 90th percentile, hit as high as 51%.
Wow. Okay, so some can grow fast.
Some definitely can.
Yeah.
Their median net revenue retention, NRR, which tells you how good they are at keeping and growing revenue from existing customers.
Right. Keeping customers and getting them to spend more.
Exactly. That was a healthy 104%, meaning they're growing slightly even from their existing base. And their gross revenue retention, GRR, which just looks at how many customers they keep, period.
Without the upgrades.
Right. That was at a strong 92% median.
Those retention rates sound remarkably strong, actually, even if the overall growth rate isn't always that explosive kind you hear about with VC-backed companies.
They are really solid. And it really underscores a key point. For many bootstrapped companies, the focus is on building a solid, profitable business, rather than just chasing that hyper-growth at all costs mentality.
Sustainable growth.
Right. The founders of these bootstrap SaaS companies have created significant value, often millions, while retaining full control. For someone like you who likes to see different approaches, this data offers a tangible picture of the potential of sustainable, self-funded growth, even in the tech world.
That data really gives you a concrete understanding of what's achievable through bootstrapping in SaaS. It's less about maybe rocketing to the moon overnight and more about building a sturdy, long-lasting rocket ship.
That's a good way to put it.
Now, the need to be frugal and resourceful when you're bootstrapping, that must really foster a certain kind of creativity and problem solving, right? You mentioned innovation.
Absolutely. When you're operating with limited resources, you can't just throw money at every problem that comes up. It's not an option.
Yeah, no magic wand.
No magic wand. You're forced to think outside the box, to find innovative and, crucially, cost-effective solutions. This often leads to the development of a really lean and efficient business model, which, as we've discussed, can be a significant advantage in the long run. Even if the company eventually grows much larger, it becomes ingrained in the company culture.
So it's like necessity becomes the mother of invention in the business world.
Pretty much, yeah. You learn to be incredibly resourceful, and that becomes a core competency.
However, relying solely on the money you bring in, that must also present its own set of hurdles, right? What are some of the potential downsides or challenges of bootstrapping?
Oh, definitely. One of the most significant challenges is, without doubt, limited cash flow, especially early on.
Right, money can be tight.
Very tight. This can sometimes slow down your ability to invest in new product development or maybe expand your marketing efforts as quickly as you might like. You're fundamentally tied to the pace of your own earnings.
You can only grow as fast as your profits allow.
In many cases, yes. There's also the potential for higher levels of personal stress. Let's be honest about that.
Yeah.
When your personal finances are so closely intertwined with the success of the business, which they often are in bootstrapping, the pressure to succeed can be really intense. It's a lot of
Yeah,
responsibility resting squarely on the founder's shoulders.
that makes perfect sense. The stakes feel much higher when it's your own neck, your own savings on the line. Despite these challenges, though, we've seen that some incredibly successful companies started out this way. Can you share a few more examples? Well-known companies that bootstrapped, at least initially.
Sure. We've already talked about GoPro.
Yeah.
Consider giants like Amazon.
Amazon. Really?
Yeah, Jeff Bezos famously started it from his garage,
Mm-hmm.
focused on slow, steady growth initially, fulfilling orders himself. Facebook began as a dorm room project, right? Mark Zuckerberg and his co-founders funded it initially themselves.
Right. Before the big investors came later.
Exactly. GitHub, a platform beloved by developers, was launched as basically a side hustle, a weekend project.
Right.
The founders covered the costs. It eventually sold to Microsoft for, what, $7.5 billion?
Wow. Billions. Okay.
Basecamp, known for its project management software, grew organically from a web design firm. No early outside investment. Even media outlets like TechCrunch or dating sites like Plenty of Fish.
Plenty of fish.
Yeah, Marcus Friend bootstrapped that to significant traction and revenue before it was eventually acquired. These examples really highlight the potential scale that can absolutely be achieved through bootstrapping. It's not just for small lifestyle businesses.
Those are some truly impressive names, showcasing the incredible potential of this approach.
Ah,
Now, within the world of bootstrapping, there's this concept I've heard about called a customer-funded approach.
yes, customer funding.
What exactly does that involve? How does that work?
The customer-funded approach is a really smart strategy within bootstrapping. Essentially, the business uses the money it generates from its operations, and crucially from its customers, to finance its growth.
Okay, so the customers are the funders.
In a way, yes.
Yeah.
Instead of relying on venture capital or piling up personal debt, the idea is that by solving real problems for customers or creating really delightful experiences, you can actually generate the funds you need to operate and expand directly from them. Your customers become your investors, in a sense.
So the customers themselves become a key source of capital. Are there different ways this customer-funded approach can play out, like specific models?
Absolutely. There are 5 main customer-funded models that have been identified and are quite common.
Okay, what are they?
First, there's the matchmaker model. This is where you connect buyers and sellers without actually owning the goods yourself. Think of Airbnb or eBay.
Right, they just provide the platform.
Exactly. They earn commissions, so they don't need to invest heavily in inventory. Then you have the pay in advance model. Pay in advance? Yeah, customers pay for at least part of the product or service before they receive it. This could be custom software development, consulting projects, or even companies like Dell back in the day, who famously built computers to order only after getting paid.
Right. Build to order.
Yep. The subscription model is one we all know really well now.
Oh, yeah. Netflix, Spotify.
Exactly. Customers pay regularly monthly, annually, for ongoing access to a product or service. That provides predictable, recurring revenue. Then there are scarcity-based models.
Scarcity, like limited editions.
Sort of. It could be limiting the availability of product or service for a specific time, creating urgency. Think flash sale sites, like Zara's early online model, Vente Privé. This allows the seller to often pay their suppliers after the sales are made, using the customer's money.
Clever. Okay, what's the last one?
Finally, there's the service-to-product model. This is where a company starts by offering customized services, maybe consulting or design work. And then they leverage that expertise, what they learn from those services, to create standardized products they can sell to a much wider audience. Microsoft is a classic example, initially offering custom software solutions, then transitioning to selling packaged software like Windows and Office.
That's a really insightful breakdown. 5 different ways customers can fund your growth. It emphasizes how deeply understanding and serving your customers can directly fuel your business without relying on traditional investment.
Exactly. Customer traction becomes your proof point and your funding source.
Now, when you're bootstrapping and so dependent on your own cash flow, keeping a close eye on your burn rate must be absolutely essential, right? We hear that term a lot.
It's fundamental. Burn rate is a critical metric for any startup, really, but it's particularly vital for bootstrap companies because you don't have that big cushion of investor cash, usually.
Right. So what is burn rate, simply put?
In simple terms, it's the amount of cash your company spends each month. More specifically, it's the rate at which a company is losing money, essentially, when your expenses exceed your income. It's your negative cash flow.
Okay, the money going out the door faster than it's coming in.
Precisely. Knowing your burn rate helps you understand exactly how long you can keep operating with your current level of funds.
Your runway.
Your runway, exactly. Before you either need to bring in significantly more revenue or find other funding or make some serious cuts.
So it's like knowing how much fuel you have left in the tank.
Yeah.
How do you actually calculate this burn rate? Is it complicated?
No, not really. The most straightforward and useful number for understanding your runway is your net burn rate.
Net burn rate. Okay.
This takes into account any money that's coming into the business as well. You simply subtract your total revenue, cash received, for the month from your total expenses, cash spent for that same month.
Expenses minus income.
Right. The result is your net burn rate, how much cash you actually used up that month. Now, if that number is actually negative,
Ah, that means income was higher than expenses.
exactly. That's fantastic news. It means you're bringing in more money than you're spending. You're profitable, cash flow positive. That's the ultimate goal for a sustainable, bootstrapped business.
So a negative burn rate is the holy grail. And understanding this number helps you make informed decisions about managing your spending, knowing when you need to ramp up sales efforts, that kind of thing.
Absolutely. It dictates your planning horizon.
Now, shifting focus slightly again, I came across some really interesting insights into the mindsets and habits that tend to be common among self-made millionaires. And these seem particularly relevant for bootstrapping entrepreneurs who are, building everything from scratch.
That's absolutely right. There are definitely certain ways of thinking and specific habits that often distinguish those who achieve significant financial success independently. They often align very well with the bootstrapping ethos.
Like what? What stands out?
One really important shift is moving away from what some call a blame ego to an ownership ego.
Ownership ego. What's that?
Instead of looking for external reasons or blaming others when things go wrong in your business or your finances, you take personal responsibility. You own it. You ask yourself, okay, what could I have done differently here?
Taking responsibility.
Yes. And then, crucially, you identify a concrete action, a step you can take to prevent that same situation from happening again. This proactive mindset is incredibly empowering. It helps you learn faster and, frankly, helps you create your own luck over time.
That's a powerful mental shift, taking control and learning actively from every setback, big or small. What are some other key habits that often stand out for successful self-starters?
Understanding the right order for managing your money is another big one. The general principle is to prioritize saving first. Build that solid financial safety net and emergency fund that can cover several months of living expenses.
Get the cushion first.
Get the cushion first, before you start aggressively investing for long-term growth. Also, consciously shaping your environment to support your productivity.
What do you mean by that?
Like setting up your workspace, minimizing distractions, surrounding yourself with supportive people, rather than just relying on sheer willpower alone, which can be exhausting. That can make a huge difference.
Okay, making it easier to do the right things.
Exactly. Cultivating frugality is also key. But it's about being smart with your money, focusing on value, balancing time and cost, not just about both the absolute cheapest option available.
Frugal, not cheap. Got it.
All right. Successful individuals also tend to be proactive about legally optimizing their taxes. Understanding deductions, credits, tax advantage accounts like ISAs or Roth IRAs, making sure they're not overpaying unnecessarily.
These all sound like really practical and actionable steps anyone can implement, really. What else is often seen?
Consistently paying yourself first is a classic for a reason.
The 10% rule or something like that?
Yeah, automatically setting aside a minimum percentage of your income into savings or investments right off the bat before you have a chance to spend it. That's a crucial habit. Avoiding bad debt is another big one.
Bad debt being?
Generally consider debt for things that go down in value, or just consumption, like credit card debt for everyday spending. The principle is focusing on buying things you can actually afford outright, unless it's strategic debt, like maybe a well-considered mortgage or potentially a business loan later on.
Right. And tracking everything.
Absolutely.
Yeah.
Diligently tracking your income and expenses. You need to know exactly where your money is going. This helps prevent lifestyle inflation, that common trap where your spending just creeps up automatically as your income increases.
Keeping spending in check even when you make more.
Exactly. Having clear financial goals and a well-defined plan to achieve them is also vital. Understanding your assets, your liabilities, knowing the steps you need to take, and finally, not waiting too long to start investing your savings strategically once you have that emergency fund built. Letting your money work for you to beat inflation.
These habits really paint a picture of building a strong, disciplined financial foundation, which seems so critical when you're bootstrapping a business and your personal and business finances are often so closely linked, right?
Incredibly critical. They often feel like one and the same in the early days.
Now, thinking back to some of those bootstrapping success stories we mentioned, it seems like an unwavering focus on really delighting customers is a common thread, even without massive marketing budgets.
Oh, absolutely. It's often the secret weapon. Take the incredible story of Rose Blumpkin, or Mrs. B, who founded Nebraska Furniture Mart.
You mentioned her earlier.
Yeah, she started with a tiny $2,500 investment. She didn't even speak fluent English initially, couldn't read or write well, but through sheer grit, tireless hard work, and an absolute dedication to taking care of her customers, finding them the right product at a fair price, going the extra mile.
Wow.
Her business grew to a staggering $1.5 billion in annual sales without ever taking on additional outside capital,
That's unbelievable, just from customer focus and hard work.
pretty much. Then there's the founder of Enterprise Rent-A-Car, Jack Taylor. He built an extraordinary business out of, let's face it, ordinary rental cars.
Right, nothing fancy about the cars themselves.
Nope. But he made customer satisfaction his absolute top priority, picking people up, really focusing on service. These examples powerfully illustrate that creating exceptional customer experiences has a far more lasting impact and builds more loyalty than simply competing on price. People remember how you made them feel.
It really drives home the point that even without huge marketing budgets, exceptional customer service can be a powerful engine for growth. And it circles back perfectly to that key benefit of bootstrapping we discussed.
Hmm.
A stronger, more direct connection with your customers because you depend on them.
You really do. Your survival depends on them being happy.
Okay, let's just touch on calculating burn rate one more time, but with a really practical sort of how-to perspective for someone who's actually running a bootstrapped business day to day. How do they track it easily?
Okay, the most practical way is to regularly review your business's cash flow statement.
The cash flow statement, not the profit and loss.
Cash flow is key for burn rate because it tracks actual cash moving in and out. Profit includes non-cash things sometimes. The cash flow statement tracks all the money coming in and going out over a specific period, usually a month.
Got it.
By looking at the bottom line, the net change in cash for the period toe, you can easily see the net amount of cash your business actually spent or gained during that month.
So just look at the change in the bank balance, essentially, after accounting for everything.
That's a simplified way to think about it, yes, though the statement gives more detail. Tracking this figure consistently, month after month, will allow you to calculate your average burn rate.
So don't just look at 1 month, look at a trend.
Exactly. Look at the trend over several months to get a reliable average. Understanding this number, your average net burn rate is absolutely crucial. Because, again, it tells you precisely how long your business can continue to operate with its current level of revenue and cash reserves without any additional funding coming in.
Your runway. Got it.
It's a vital metric for making informed decisions about managing expenses, forecasting cash needs, and planning for the future. You need to know it.
So it's not a one-time exercise, but really an ongoing process of monitoring and understanding your actual cash flow. Okay. Finally, let's imagine a bootstrapped company reaches a point where maybe they've had some success, they're stable, but the founders decide they might need to explore outside funding to really scale up to take it to the next level.
Right, that happens. Bootstrapping doesn't mean you never take funding.
What are the initial steps they should take to prepare for that possibility, to get ready to talk to potential investors or lenders?
Okay, the very first step is to conduct a really honest and thorough assessment of their business idea and their overall business plan, even if they've been operating for a while.
Revisit the plan.
Exactly. This includes preparing detailed and, importantly, realistic sales and expenditure forecasts going forward. Potential investors or lenders will want to see a clear, credible, and well-articulated path to future profitability and sustainable growth.
They need to see the potential return.
Absolutely.
Yeah.
It's also absolutely essential to have a clear understanding of exactly how much funding is needed, not just a vague number.
Be specific.
Be specific and be able to convincingly demonstrate how those funds will be used, product development, marketing expansion, hiring key people, whatever it is, and most importantly, how the company will be able to either repay any debt acquired or provide a compelling return on investment for equity investors.
You need to show how their money makes more money.
Precisely. You need a solid data-backed story.
So even if you've built a successful bootstrap business up to that point, having a solid, almost investor-ready plan is crucial if you decide you want or need to explore other funding avenues down the line.
It makes that transition much smoother and increases your chances of success.
Well, this has been an incredibly insightful journey into the world of bootstrapping. Really fascinating stuff.
It truly has. Yeah, it's a powerful model. To quickly summarize, maybe, we've seen how bootstrapping really empowers founders with significant control, right?
Definitely. Control is key.
It cultivates strong financial discipline, forces efficiency, and often leads to that deep and really valuable focus on customer satisfaction,
Because you have to.
because you have to.
Mhm.
And while it certainly presents its own set of challenges, the stress, the cash flow constraints, the remarkable success of numerous well-known companies proves that it's a very viable and often incredibly rewarding path.
For sure.
Understanding those core principles like self-reliance and cost efficiency, diligently managing your cash flow by keeping a close eye on your burn rate, and always prioritizing the needs and satisfaction of your customers.
Yeah.
Those seem to be the essential ingredients for success when building a business this way.
Absolutely. And it really prompts you to think maybe even if you're not currently planning to build a business from scratch, which of these bootstrapping principles, like resourcefulness, that customer centricity, or even those clever customer funded models,
Mm.
which of those could you potentially apply to your own projects or your career or other areas of interest?
That's a great point. That mindset is transferable.
Yeah, it's a powerful reminder of the value of ingenuity, of doing more with less, and really focusing on the people you're trying to serve or the value you're trying to create.
Well said.
We definitely encourage you to explore some of the companies and ideas we've talked about today if this sparked your interest. Thanks so much for tuning in.